Hello and welcome to How to Invest Better, the multimedia audiovisual CD-ROM series produced by me, Alpesh Patel. We're looking at money and risk management in this 3 CD-ROM set and some of the insights from the world's leading traders on those topics. Now, they're topics which you don't hear about on the TV screens and in the magazines, and the reason for that is because they're incredibly important topics which only skilled practitioners, not TV presenters and journalists, understand. And that's why I want to give you the information which we traders use, and not just what sells magazines, because what sells magazines is next week's hottest stock tip. Well, next week's stock tip or hottest stock tip is not going to get you very far if they don't tell you when to get in, get out, how much money to put on it, and the fact that you actually need to protect the downside far more than which are the correct stocks. And you'll see why as we progress through these CD-ROMs, why those things are far more important. Now let me introduce you to this little character here, and what it does is it's going to highlight the areas that I'm looking at and that I want to draw to your attention. So what we should do is kick off. Where are we starting? Well, let me give you an overview. Anybody who's got the other CD-ROMs in this set will know that the overview is that with any decent trading vision and mission statement, there's the 3 M's. There is money management, which is what we're dealing with in this CD-ROM. There is mind, or trading psychology, and there is method, or trading systems. Those 2 subjects are dealt with in the other CD-ROMs. When you combine all 3 of these things, you get to what all traders are after in their mission statement, which is profits. Mind is over here, I should say, money and method. We're concentrating on money for this one, a very important component indeed. So, what are some of the things that we're going to be covering in this 3 CD-ROM set? Well, first of all, let me let you know that I've broken these down into chapters. And each chapter roughly lasts about 10 minutes long, so you get lots of breaks, you can take in the material, you can return to something which you're unsure about, and so forth, and you know roughly whereabouts you are. So obviously you've just clicked on chapter 1, which is where we are. Topics we're going to be covering, well, yes, exactly why is risk management so important? How do professional investors and traders handle losses? Why do the world's leading traders, or what do the world's leading traders rather say on risk? And this we're going to get straight from the horse's mouths, i.e. the world's leading traders themselves. How could I, or anybody else for that matter, if they wanted to trade full-time, the do's and don'ts of leaving a day job to trade full-time, and all the classic private investor mistakes that are made by private investors when they're managing money and risk. How much money do you need to start off with? That's a common question, but we're going to be answering that. And what are the mistakes that traders make when they're trying to understand risk? And I'm not actually going to talk about just 5 errors that I bet you make. I'm going to talk about a heck of a lot more than that, because as I was putting this through, I realized that, well, why stop at 5? Why don't I just tell you about some of the other ones and then some? And that's not all. We're going to look at simple calculations which will tell you how much money to put in trades, and they'll save you money when trading. How much money should you put on any one trade? That's always a toughie for people, and I have to tell you, it's one of the most important things to understand. When you understand that, you'll see why we traders look at things in a completely different way to what private investors and how private investors look at things. What's the right level of reward you should be getting for any level of risk that you're taking? How many stocks should you own at any one time? By the way, the answer to that's 14. When do you know to take a loss and to avoid a larger loss? This is all about money management and what to do. The trade goes up after you sell it. These kinds of things, the right win-loss ratio, finding low-risk, high-return trades, and what's the most you should ever lose on a single trade, they all come down to money management. There's not a single thing about, hey, front cover of a magazine, 10 stocks you must own now for your retirement, and all that rubbish which is put on magazine covers to help to entice you into buying more stocks. What they should put on is, what's the most you should ever lose on a single trade? Those kinds of things are far more important. Let's move on, if I may, to a first part of this important aspect of money management, which is just to get an idea of the amount of risk that you're willing to take. This is something you should be familiar with yourself. That's why it's important. It's important that you understand the level of risk you're willing to take. So I want you to run through several questions that I've written down here. With the first one, I'll kick off and show you what I mean. 1. The degree to which the value of an investment moves up and down is referred to as volatility. In general, more volatile investments tend to grow faster than more stable ones. They have a larger potential upside, basic stuff. However, volatile investments are more risky since there is no guarantee the upturns will be larger than the downturns. How much volatility are you willing to accept? This is so we can gauge the level of risk you're willing to take, A, B, or C, and then you mark down the number of points, and the points are written down in brackets here. Is the answer A? This will be something which only you can answer. How much risk you're willing to take? Slight, some, considerable. Considerable would be I'm willing to take substantial risk in pursuit of significantly higher returns. And mark down the number of points on a piece of paper or so forth. Remember, you can pause the presentation at any time if you need to look at this in more detail, slow down and make notes, for instance. The next question is what you should be doing. Suppose your investment portfolio contains a significant portion of large company stocks, in addition to several other assets. Large company stocks have averaged a compound annual return of about 11% over the past 72 years. However, if a large company stock lost 18% of their value in the past year, what would you do? Would you sell? Would you sell some but not all? Would you continue to hold? Would you buy more large company stocks? And you can see how the marks are written down. It's either 1, 2, 3, or 4, and you can write down the number of points. If you said D, you'd buy more large company stocks, and the answer is 4, and you'd put the answer over here. And just make a note of it on a piece of paper. Similarly, question 3, provide your response to the following statement. Given my investment time horizon, I am willing to accept significant fluctuations in the value of my investments to achieve potentially higher long-term returns. Would you agree, disagree, strongly disagree, disagree, agree, or strongly agree? Total points over here. Once you've made a note of that, move to the next one. Don't worry, there's not a load of these, it's just a few. I just want us to know the level of risk we're willing to take. You need to know that so when we go forward and look at some of the examples, we know where we stand and what you should be focusing on. Which of the following statements is most true about your risk tolerance and the way you wish to invest to achieve your goals? Is it, my investment should be completely safe? I do not wish to run the risk of losing any principal at any time. General regular income that I can spend. Generate some current income and also grow in value. Grow over time. Grow substantially in value over time. I do not need to generate current income. 1, 2, 3, 4, 5. Add your points there. Question number 5. As I said, it's a bit like a doctor providing you some sort of home diagnosis. An investor must be prepared to expose his or her investments to increased chances for loss in the attempt to achieve higher expected returns. The following statements represent possible outcomes for 3 hypothetical portfolios at the end of 1 year. Which investment portfolio would you be most comfortable holding? A, B, or C? A is where the likely return is 6% and there's a 10% chance for loss at the end of the year, all the way down to portfolio C, which has a likely return of 14%, and there's a 25% chance for loss at the end of the year. Which one of these are you most happiest with? And add up the points and put it on a piece of paper. Question number 6. I understand the value of my portfolio will fluctuate over time. However, the maximum loss in a 1-year period that I'm prepared to accept is... Which one of those figures is the maximum you're willing to accept? 7. Investments in which the principal is 100% safe sometimes earn less than the inflation rate. This means that while no money is lost, there's a loss of purchasing power. With respect to your goals, which the following is most true, my money should be 100% safe, even if it means my returns do not keep up with inflation. That might be, for instance, putting something in a bank account. All the way across to, it is important that my investments grow faster than inflation. I'm willing to accept a fair amount of risk to try to achieve this. 0, 3, 5 total. Okay, 8, we're nearly near the end. Which statement best describes your main concern when selecting an investment? A, the potential for loss. B, mostly potential for loss, but also potential for gain. And so forth, the potential for gain. 1, 2, 3, 4. Now, consider the following 2 investments, A and B. Investment A provides an average annual return an annual average return of 7% with minimal risk of loss of principal. Investment B provides an average annual return of 10%, but carries a potential loss of principal of 20% or more in any 1 year. If I could choose between investment A and investment B to meet my goals, I would invest my money in. Now, how would you divide it up? And again, mark down the score there, and you can see basically what we're getting at, I should think. Okay, now tot up the marks and let me tell you what it all means. If you tended to go for the former options in the above questions, then you're quite risk averse, and that's fine, that's entirely up to you. So if you scored between 8 and 20, then you tend to be particularly risk averse. 36 and 50, and you like market volatility, regarding it as the best opportunity to make money. Now, the reason I want you to note this down is because I'm going throughout these CD-ROMs is say, well, okay, look, this is what the risk-averse people might want, and this is what the risk-loving people may want to do. That's why I want you to have an idea of where you are on this scale. Now, that's the end of Chapter 1. We'll move on to Chapter 2 next.